Have you ever wondered how the stock market works? A place where fortunes are made, lost, and often remade. An intricate web of buyers and sellers, of risk and reward, of dreams and reality. Is it a casino for the daring, or a platform for the prudent? Is it an economic indicator or a playground for speculators? Each question perhaps more fascinating than the last. So, let's embark on a journey to decode these mysteries. Let's dive into the world of stocks and exchanges. To put it simply, a stock market is like a giant global marketplace. But instead of buying and selling goods like fruits, vegetables, or clothes in this marketplace, we buy and sell stocks. Now, what are stocks, you may wonder? Well, stocks are essentially a slice of ownership in a company. When you buy a stock, you're buying a small piece of that company, becoming a part owner or a shareholder. Just like in a traditional marketplace, prices in the stock market fluctuate. But instead of being dependent on the quality of the produce or the demand for a particular item, stock prices depend on the company's performance, investor sentiment, and broader economic factors. Imagine walking into a bustling marketplace. On one side, you have sellers, who are companies in this case. They decide to sell pieces of their companies or stocks to raise money for various needs. It could be for expanding their business, launching a new product, or maybe paying off some debt. On the other side, you have buyers who are the investors. They buy these stocks hoping that the company will do well and that their slice of the company will grow in value over time. If the company performs well, the demand for its stock goes up, and so does the price. If it doesn't, the opposite happens. The stock market is facilitated by exchanges, places where buyers and sellers meet to transact. Some of the well-known exchanges include the New York Stock Exchange and the NASDAQ. These exchanges ensure that trading is conducted in an orderly manner, and they provide the infrastructure for these transactions to take place. In essence, the stock market is a complex, dynamic system where millions of transactions occur every day. It's a place where companies and investors come together, each with their own goals. Companies aim to raise funds to grow their business, while investors seek to grow their wealth by investing in these companies. So, the stock market is where shares of companies are bought and sold. It's a fascinating world, a blend of economics, human psychology, and business strategy all playing out in real time on a global stage. Now you might be wondering, why would a company want to sell its ownership? Well, the primary reason is to raise capital. Just like how you might sell a piece of your prized comic book collection to fund your dream vacation, companies sell parts of their ownership, or stocks, to raise money. Let's imagine a small business owner, say, a baker. He makes the best bread in town and wants to expand his bakery to multiple locations. However, he needs money to do that. Instead of taking out a loan, he decides to sell a portion of his business in the form of stocks. Now, several people own a piece of the bakery and they share in its success or failure. This way, the baker raises the necessary funds for expansion without accumulating debt. It's a win-win situation. The business gets to grow, and the new owners get a share of the profits. In essence, selling stocks is a way for companies to raise money without taking on debt. So, where do you and I fit into this picture? Well, we step into the scene as investors. Our role is crucial in the grand scheme of the stock market. But what exactly does it mean to be an investor? Being an investor, in essence, means becoming a part owner of a company. When we purchase stocks, we are buying a piece of the company, a share of its success or failure. Our investment, pooled together with those of countless other investors, provides the company with capital, money it needs to grow, innovate, and excel. Now, we don't invest out of the goodness of our hearts. No, we invest because we believe in the potential of the company. We see a bright future, a vision of success, and we want to be a part of it. We hope that, over time, the company will flourish, and the price of the stock we bought will increase. If that happens, and we decide to sell our stock, we make a profit. That's the basic principle of investing. However, it's not always as straightforward as it sounds. The stock market is a complex beast, filled with ups and downs, bulls and bears. The price of a stock depends on a myriad of factors, from the company's financial health to global economic trends. It's a game of strategy, knowledge, and a dash of luck. But despite the risks, investing plays an integral role in our economy. It allows companies to raise funds for growth and expansion. It offers individuals and institutions the chance to grow their wealth. And it plays a part in shaping the economic landscape of our world. So, as investors, we are not just bystanders in the world of finance. We are active participants, drivers of growth, and shapers of economies. We put our money on the line, betting on the success of companies, and in turn contribute to the overall health and growth of our economy. As investors, we essentially become part owners of the company, hoping to share in its success. The stock market, like any investment, comes with its own set of risks and rewards. But what does that mean for you, as an investor or potential investor? Let's delve a little deeper. On the one hand, the stock market has the potential to provide significant financial gains. Let's take the example of a tech startup. Let's call it Tech Titan. A few years ago, Tech Titan was just a blip on the radar, their shares barely worth the paper they were printed on. But those who saw the potential in this fledgling company and invested early are now reaping the rewards. Tech Titan's success story is one of many in the stock market, where investors who took a chance on a promising company ended up with returns that far exceeded their initial investment. On the other hand, the stock market can also lead to financial loss. Consider the case of another company, we'll call it Sunset Solar. Sunset Solar seemed to be on the rise, promising cutting-edge solar technology that would revolutionize the energy sector. Many investors were drawn in by the hype and invested heavily in Sunset Solar. Unfortunately, the company's ambitious plans didn't pan out. The technology wasn't as groundbreaking as it seemed, and the company failed to secure necessary funding. The result? Those who invested in Sunset Solar saw their investments shrink, some to the point of total loss. This serves as a stark reminder that the potential for high returns in the stock market also comes with the risk of significant losses. So how does one navigate this precarious balance between risk and reward? The answer lies in understanding the market, conducting thorough research, and making informed decisions. It's about discerning the tech titans from the Sunset Solars. It's about knowing when to take a chance and when to hold back. The stock market is a game of risks and rewards, and understanding this balance is key to successful investing. Remember, the goal isn't to win every time, but to make more right moves than wrong ones over the long haul. Let's quickly recap what we've learned. We've embarked on an exciting journey today, delving into the intriguing world of the stock market. Imagine it as a bustling marketplace, only instead of buying and selling goods, participants trade in shares of publicly listed companies. This is the stock market, a vital cog in the machinery of our global economy. We then learned why companies decide to sell stocks. It's all about raising capital. Companies, especially those in their growth phase, need funds to expand their operations, invest in research and development, or perhaps pay off existing debts. By selling a portion of their ownership in the form of stocks, they can generate the necessary capital without the burden of repayment, as with a traditional loan. But what about the investors? Yes, we talked about their role too. Investors, both individuals and institutions, buy these stocks with an expectation of financial gain. The profit comes in two forms: dividends, a share in the company's profits, and capital appreciation, where the value of the stock increases over time. By investing in stocks, they essentially become part owners of the company, albeit on a smaller scale. Of course, the stock market isn't all sunshine and rainbows. There are risks involved, and we've touched upon those as well. The value of stocks can fluctuate, sometimes dramatically, due to various factors including market sentiment, economic indicators, and company performance. There's always a chance that the stock price might fall below the purchase price, leading to potential losses for the investor. But remember, with greater risk often comes greater reward. Over the long term, investing in stocks has historically proven to yield substantial returns. But here's the thing. The stock market isn't a get-rich-quick scheme. It requires patience, discipline, and a keen understanding of market dynamics. And that's precisely why we're here, isn't it? To arm ourselves with knowledge, to understand the nuances, to make informed decisions. So keep learning, keep exploring. After all, the stock market is a fascinating world, filled with opportunities and challenges. And with that, you're on your way to understanding the stock market. Remember, knowledge is the first step to successful investing.